Chris, thanks for being here today talking about valuations. Let's just start with the basics. So, talk to me about why people seek a valuation. Obviously, for exits, which we're talking about primarily today, but are there
Yeah,
other reasons people seek valuations? And just walk us through why and
yeah,
when they should do that.
you bet. No problem. Thanks. First of all, thanks for having me, Cindy. I appreciate it. Yeah, you hit the nail on the head. I mean, in my practice right now, I would guess a significant majority of what I'm doing is somewhat focused around some sort of exit planning, whether it's a transition to another generation, whether it's one partner buying another partner out, one shareholder buying another shareholder out, some sort of transition. I'm guessing that that's probably making up 50 to 60% of what I'm doing right now. Another very common reason, I mean, at the end of the day, we are accountants and we do a lot of estate and gift tax work as well. If a shareholder or partner in a small business passes away, unfortunately, or decides to gift some interest, there's federal income tax reporting that often goes along with that, which in many cases requires a valuation of that business if they own a piece of that equity, that business. That's probably number two reason. Beyond that, I mean, it could be just a simple matter of compliance issue where they've got a buy-sell agreement that simply requires a valuation done every year, or if they're part of an ESOP, that's an annual valuation that needs to be done. Unfortunately, cases of divorce, occasionally you'll end up in front of a court, in front of a divorce, or with a divorce attorney in front of a family court, testifying to the value of a business for settlement or support purposes. Loan,
Curiosity.
yeah,
Does it become for curiosity? Like, how
yeah,
much is my
right.
business worth?
Honestly, I did have a client that once he's like, I'm not, I think probably ostensibly you could say it was for planning, but he was like, I'm not going to retire for 7, 8, 9 years, but I'm just kind of curious where I'm at today so that I
Hmm.
can plan and start building towards maybe a better number in the future when I do, when the time comes to pull the trigger. So yeah, I did have one that I called, you're right, a curiosity
Yeah.
valuation.
Not a bad idea, right? Because like if your valuation is, lower than you want it to be, then you got to put the pedal to the
For
metal,
sure.
right?
Well, and
Yeah.
we talk a lot in our industry about, you in many cases small, and primarily I'm in the business in the area of small business owners. I'm not valuing publicly traded companies and things like that. For most of these people, this business that they've worked and built over the course of their lifetime, it is most likely the most valuable asset they own. And to be able to plan, yeah, maybe they've got a retirement account, maybe they've got a primary residence, but at the end of the day, this business is probably going to be the bulk of their retirement. And especially as they age and get closer to that age, knowing what that's worth so that they can plan for their future is a pretty big deal.
Yeah. Yeah. So let's go to the exit process and valuation. So, I mean, there are definitely serial entrepreneurs out there who've been through this many times, but a lot of
Sure.
people have never been through it. So
Yeah.
walk us through the valuation process, like what to expect, how does it happen, how long does it take, all the things.
Yeah, and it's really interesting from my perspective. I am a CPA as well as a valuation expert, so I always feel like in the CPA world, we're always looking sort of backwards. We're filing a tax return for what happened last year. We're doing an audit for what happened last year. We do planning and things like that as well, but really the focus of what we do is looking backwards. And especially when I'm working with some of my own tax clients, then when I put on my valuation analyst hat, it's like, okay, now we're completely shifting focus and say, okay, let's look to the future. What are we expecting this business to do? Is it in a growth cycle? Is it stagnant? So I guess the first, you talked about the process. The first step is really just a conversation with the business owner, kind of setting the parameters. What are you looking for? Why are we doing this? Talk to me about your business. Talk to me about and this becomes much more important in cases where they're not a current tax client of mine, where I don't know the business as well. Talk to me about the history of the business. Who are your key employees? Who are your big competitors? What's the industry doing? Did a valuation a while ago on a small publisher, and then obviously the print publishing industry is not exactly a growing industry these days. So it was a lot of conversation about, okay, talk to me about that and what that means for you and what sorts of things are you doing to maybe help out with the decline in the publishing industry. So
Yeah.
just a big conversation like that.
Okay.
Beyond that, then I kind of let the owner cut them loose and say, give me some time now to really dig in. I usually ask for some financial information. If they've done projections for the future, again, valuation tends to be a forward-looking, future-focused. Fantastic. Again, working with small businesses, 99% of them don't go to that effort. Okay,
Like
well
books?
then,
What do
yeah.
you mean books?
So then give me 5 years worth of financial information, and for some of them they've got really good financial statements that either our firm or maybe another firm has helped them with, and that's fantastic. They don't have that. Well, okay, do you at least have a tax return that you can show me that I can at least say what you're reporting to the IRS, and I have a somewhat fair confidence that you're probably reporting pretty accurate stuff to the IRS, at least I hope you are. At least give me something so I can get a grasp of what we're talking about here. Are we talking about a business that is basically you're buying a job where you're just, you're paying yourself a salary, but there's really not any growth in the business. You're not really earning anything as an owner, or is this a really highly profitable business where you've, and you can reinvest in the business, you're continuing to grow it, and start looking at some of the trends financially in the business itself. Again, growing, shrinking. Is it one of these cyclical businesses that goes up and down constantly? Is it on a fairly steady up or down path either way? What's the earnings history like? Is really of primary importance. And then I do that. I do some research into the industry, do some research into the economy, and ultimately then produce a report that gives my opinion. That we have a few different methods we can use depending on the type of engagement we're having. We can use as many or as few of these as are appropriate, and just kind of ultimately get that into a final number and then deliver my report. And then I usually like to have a follow-up conversation at the end. Let them read through it. It can get highly technical and accountant-ese every once in a while. So, if something doesn't make sense, let me know. I can kind of walk you through the thought process.
Yeah. Talk to me a little bit about, you mentioned the beginning, just kind of getting to know them. What are obviously the financial factors seem obvious, right? Like
Yeah,
making
for
money or
sure.
not making money. What are some of the non-financial pieces? You mentioned employee teams and things like
Yeah.
that factor in.
Yeah, so again, really understanding the purpose of what's really going on and triggering the need for evaluation is really important. So, for example, if I did one a couple years ago where it was two partners who had been in business for a long time together, the one partner was probably the doer, and one partner was, say, the rainmaker in the in
Mm-hmm.
the in the business,
Mm-hmm.
and it was the rainmaker that was buying the doer out, for lack of a better term.
Yeah.
So it was really important to understand that, okay, this partner that is going to be exiting the business is really he's the credentialed person that understands and is doing a lot of the work.
Yeah.
So if you're buying him out, you're going to have to replace that. So that's really important to understand, to know, because I'm going to need to adjust my financial analysis accordingly, because that person's going to have this remaining partner is going to have to go out and find that
A new
person,
expert.
a new expert to actually do the work. They're not going to be the ones doing it. So just picking up on some of that type of stuff is really important. Again, just really understanding the industry is probably of utmost importance. I'd like to say I'm an expert in all the industries out there, but I'm not. So, there's a few that I've done more than my share of, so I feel pretty confident, but a lot of them are new to me, and I just need to really understand, talk to me about, is this an industry that there's a lot of new players coming in the market? For a while, accounting industry was shrinking with not a lot of new accounting students. That would be important to know, that it's going to be hard to find, or it may cost you more money to replace accountants. I just use that as an example because I know the industry well.
Because you know that one, you're in
But
it.
yeah,
Yeah.
but if I didn't, that would be important information to know. Yeah.
Yeah. And so I'm sure if as a business owner myself, I'm like,
Yeah,
how
sure.
final is that number?
Yes.
When you
Yep.
come up with a number and you do have sort of the non-financial and the financial aspects, like, is there room for the owner to come back and say, hey, this is obviously we're going to get into the emotions a little bit later, but
Yes.
just talk about how
Yes.
hard and fast that
No.
number is.
We talked a little bit how I like to have sort of an exit conference, or at least a quick phone call at the very least at the end of doing evaluation. And one of
Mm-hmm.
the things I really always conversation I always have is, what I've given you is the value. And especially if we're talking about a transactional issue, that while you may think it's the same thing, it's a completely different concept than the price that you
Mm.
ultimately pull the trigger on.
Oh, that's a good point.
Because at the end of the day, what I'm giving you, and again, we depends on the purpose and some of the terms we agree upon at the beginning of the valuation. Generally speaking, most of the valuations I do use what's basically a fair market value premise. And under the definition of fair market value, you're basically assuming a hypothetical buyer and a hypothetical seller, meaning I'm not allowed to let the identities of any of the parties sway my opinion.
Mm.
I basically say, what the analogy I like to use is, let's pretend I just had an angel, Bill Gates or Elon Musk, or pick your favorite billionaire, and he or she is just walking around with a pocket full of money and just wants to buy a business, and all they care about is, I want to make a decent return on my investment. I don't
Mm-hmm.
care what industry it's in. I don't care who's owning it. I don't care who's running it. So that's kind of what the concept of fair market value is I'm taking all of the emotional stuff out of it at the front end and just saying, this is just what it's worth.
Got it.
So that conversation I have is then, okay, now once we start moving to the conversation about price, well, that's bringing all of this other stuff back in. Now you're talking about a specific industry, potentially a specific buyer. Maybe you've got somebody in mind. Maybe there's a whole bunch of other extenuating circumstances out there. Maybe they're family members. You're going to give them a discount. Maybe it's a bigger company in the same industry, and for you, it's a strategic acquisition for them. So they might be willing to pay a premium over that.
Right.
That doesn't change the value. That just changes what the price is.
So I want to just, for my own edification here and just for clarity too.
Yeah, for sure.
When you're talking about the valuation, I love this distinction between the valuation and the price, right?
Mm-hmm,
so the valuation is really pretty much the numbers. And then the market value, like market, it's pretty numbers based. It's not owner based necessarily.
Yeah, it's numbers and environment based, I would say. The current economic environment, the current business environment in general. You're taking all of that into account, but you're not specifically taking the identity of the company or the identity of a potential buyer or something.
Got it. Yeah. Okay. And then this might be a dumb question, but then okay, so the owner gets the valuation and then what? Like, what do you do with the valuation? Does that go to the potential buyer? Do they want their own valuation? Like, talk about that process a little.
Again, depends a lot on the relationship. I would say my experience, again, this is just based on a lot of the companies I work with. A lot of them are, I'd say maybe half of them are legacy clients of mine through tax, or at least of our firm. So they've got a relationship already, and implicitly we have that level of trust with them where they just say, we're looking to you to give us what the number is, and we'll work for there. Yeah, in some of the more litigious, if you've got a shareholder dispute, a divorce type situation, in a lot of those cases, you're going to have an expert on each side, and then they both get hauled in front of the court and give their testimony as to why. And in a perfect world, you're doing this, in a mediation type environment before you're getting into the actual courtroom setting. But both experts are giving their and quite frankly, a lot of times the other expert will make a point and I'm like, that makes sense. And I can adjust my report accordingly, or I'll make a point and you'll say, I guess I didn't really consider that. So, and a lot of times we can converge at least upon something within a relatively narrow range, hopefully.
Yeah. Okay, that's great. Talk to me a little bit about industries that are maybe easier to value and those that are harder. And I'm guessing this is like, crystal ball kind of ish, but in general,
industry-wise, I don't know. Industries are so wide and so varied. It's really hard to say there's an industry that specifically. I think more the issue just tends to be that the harder businesses are a couple of things. One is if their financial records are a mess. Again, I'm working with small businesses. Some of them don't keep great records, again, especially if they're not our clients to begin with. And it can just be hard to really understand. We've got a lot of small mom and pop shops that the owner might be commingling their personal transactions in there. And it's just really hard to separate out and say, okay, what really is the business doing to value that business? That's probably the hardest. In some cases, if you can find like tiered companies where they're, you got a holding company, for example. I had one case where it was basically that. It was like a family partnership they wanted valued, but all it did was invested in other small companies. And I'm like, well, I'm not going to be able to value this. I need to know what the values of all these other small, I'm going to have to do a valuation of each of these other small businesses. And unless you have this information available for me, I'm not going to be able to really do anything with this. So So that can be difficult when you've got tiered levels and they just, obviously it's a time consuming effort and a lot of work. And of course they're not going to want to pay a fee to value each of these other small companies, and these other companies have no interest in doing it. So it's like, that can be difficult just because of where we're located. We do a lot of farm valuations, ag related. Those can get a little tricky just because there's so much specific terminology, and, the ag industry is quite specialized. So to know, for example, in a hog operation, tell me the difference between all these different types of hogs and what stage of production that they're at. What's a breeding animal versus one that's going to be bred and raised for sale. And same in the crop industry. Talk to me about nutrients in your field and growing crops in your field, and what's grain that's sealed and grain that's been sold. So there's just a lot of really highly technical type stuff that if you don't have that sort of background, it can be kind of tricky.
Yeah. So it sounds to me like really the bigger obstacle is less the complexity of the business. Minus the example you just gave, and more like how ready is the owner, how clean are the books,
Yeah, for
Um,
sure. And the more maybe the more specialized the industry, the harder sometimes it can be. A couple of the methods we use, one of them we call it a market approach. Think of it very similar to what your realtor does when you buy or sell a house. They go out and get comps. They're looking
right.
for other houses in the same neighborhood that are about the same size and same. So they're trying to compare and say, okay, on a comparison, how does your house rate to these other houses, and then figure out what the value is. We do the same thing in valuation, as we can find. I've got a dental practice in Iowa that is between makes between $1 million and $2 million a year, for example. Okay, well I have databases that I subscribe to that I can go find other dental practices in the Midwest of about that size and what they've sold for, and then do
Mhm.
some comparisons. So yeah, for a dental practice, that's pretty easy. When you get a really highly specialized, maybe manufacturer of a very specific product, and they're not very diversified, it's just this is what they do,
Yeah.
it's a little harder to find. You can broaden your search, and maybe you're looking at a broader class of manufacturing than just that specific product. But then how comparable are they? You don't really know. So that's
Yeah.
that's maybe a better answer too. Is just the more highly specialized the industry is, sometimes the tougher it can be just to get good information.
Yeah. 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 Sounds like an art and a science a little bit.
A hundred, a
Yeah.
100%. I've used that phrase
Yeah.
more often than.
Yeah. Yeah. So I'm gonna one more crystal ball question for you. How much does the market, like M&A activity, or economics, current economics? I mean, we're kind of in a crazy time right now economically, and a lot of
Yeah,
uncertainty with
right.
tariffs and things. Like, not that you need to address those specific things, but how much do those impact valuation, or is that really more impacting price?
No, it does it both. I mean, both to some extent. The valuation. So one of the factors we look at in our valuation is usually at some point, especially for an operating type entity, we're looking at what sort of rate of return is that angel investor that I spoke about before.
Hmm.
What is going to be a rate of return, an expected rate of return they're going to want that's going to entice them to purchase or invest in a small business. So as economic conditions get better or worse, obviously, the Fed is raising or lowering the interest rate at all times. The cost of borrowing capital changes a lot. And so conversely, then the cost of equity capital moves accordingly. So as interest rates go up, makes it harder for somebody to borrow money. So typically that affects prices. They're going to be coming down, and
Hmm.
the values accordingly, because that rate of return that they're going to expect is going to be higher. So for a business that's making a constant cash flow or earning stream, as the expected rate of return goes up, that's an inverse relationship with the value or price. So the value would go down as that expected rate of return goes up.
Yeah. I'm going to spring one more question on you.
Yeah,
Uh, your thoughts on the impacts of AI and mergers and acquisitions?
I wish I had a really good answer for you on that.
Yeah.
I mean, just within the accounting and valuation industry, both for that matter, it is a hot topic. Just every conference we go to these days, that's probably a full day's worth of presentation, if not more,
Yeah.
both in terms of how it can be beneficial to the industry. I know there's a lot in the accounting world. There's a lot of uses of AI as far as doing research and things like that. In the valuation world, they're beginning just sort of in the beginning stages of developing some AI resources that can do a lot of that research for you on maybe other comparable companies, on court cases, how IRS or courts have ruled in certain cases on different parts of evaluation, and then even some that are beginning to create just AI based templates, kind of. For better or for worse, right now, a lot of our work is still very, very labor intensive. It's writing a report. It's going back to my college composition days. My wife would love to hear this because she's was an English major and taught composition for a while. So it's a lot of recalling that, and how do you cite a source, and how do you basically draft an outline, and
Hmm.
create a 20-page paper sort of type thing. So very labor intensive still, and creating some AI tools just to kind of help with some of that process, just kind of starting to hit the industry a little bit. As far as in terms of the subject companies, the companies I'm valuing, again, that's a great question that I would love to know as I'm talking to the owner up front. Talk to me about this. Right now, if you've got a workforce of say 70 people, is AI going to change? Are you going to only need 30 people in the next 10 years to do the same work and create the same sort of financial results? And if so, that's a pretty big disruptor. I need to know that so that I can take that into account.
Yeah. This is a little bit of a leading question, but just on that little follow on, my concern is that if you don't adopt, invest, or whatnot, your nest egg, maybe you think you're going to sell for 2 million or 5 million, is maybe now only worth 500,000 or something
Yeah.
like that. Is that a
Yeah.
real concern? Or I don't want to scare people, but I also
Right.
keep your eye on it.
For sure.
Yeah.
Yeah, no, I agree with you. I don't know that it's you need to wake up tomorrow and be freaking out about anything, but at
Yeah.
the same time, it's one of those things, you know, the owner, I think the biggest mistake an owner can make is just not paying attention to the industry.
Yeah.
Again, the types of industries, types of businesses I'm working with, again, a lot of them are small. A lot of times the owner is very heavily involved in the doing the work
Hmm. Hmm.
and doing the business. They don't always have a lot of time to then work on their business. And I think that that can be a really big detriment to a value of a business if the owner foregoes that working on the business and saying, hey, there's money in the checking account. I'm able to pay the bills. Things are going fine. We're maybe our sales are increasing by 2 or 3% a year. That's great. We're just kind of on coasting. But if you're doing that but falling behind the rest of the industry that's growing at 10% because they've adopted AI or pick insert a reason here, you're falling
Yeah.
behind because you're not paying attention, that can really hurt your value.
Yeah. Yeah. Okay. So we've talked about getting your books in order. We talked about AI a little bit. So outside of those things, what's something a business owner can do now to shape, improve valuation going forward?
Yeah. At the end of the day, after all the things we talked about, what's really going to drive the value the most is really the financial results. So I think the owners that are, maybe they're not paying attention to AI, maybe they're not paying attention to what's going on outside, but they really need to be paying attention to their business more than just talking to their accountant saying, "Here's my QuickBooks file, make a tax return out of it. Great, it's done, filed, in the drawer it goes, and we're done."
Yeah.
And your accountant can help you with this, or you can even do it internally yourself. Take some time and really look. Um, what's going on with the salaries? Am I overstaffed? Am I understaffed? Let's do some industry benchmarking. Let me get out to some conferences or pull some reports and see what others in my industry are doing. Oh my gosh, my and I'm just making examples up here. Obviously, my cost of sales is 70% of my revenue, but my competitors are all making it be able to have it at 50%. What am I
Hmm.
doing wrong that I can adjust and improve my financial situation overall? That's the biggest thing, is just really working, like I say, working on your business, identifying those industry trends, benchmarking yourself, and just paying attention to the financials. Don't just treat them as, I mentioned before. Sometimes it's kind of you're looking at it retroactively after the fact. Don't look at it just as an after the fact. Okay, I got my numbers, great. Put it in the filing cabinet and move on. What can I do to improve this? What areas can I work on? What technologies can I embrace, or what things can I do that is really going to improve my bottom line? Because at the end of the day, all the other things aside, that bottom line is what's really going to drive the value in your business. And
Yeah.
and and so many businesses too. Again, even with a lot of my clients, they've been legacy clients. Their focus is on, I don't want to pay tax. I want to pay as little tax as possible. So
Yeah.
we're going to spend all this money, drive value down, blah, blah, blah. Well, that's great for tax purposes. And then when they come back the next year and say, okay, now I'm ready to transition. Well, your earnings history isn't great here.
Doesn't look
You
good.
just,
Yeah.
no, yeah, you buy yourself a new truck every year, which, yeah, in Evaluate, we can adjust for some of that stuff. We can kind of pull that out. But at the same
Yeah.
time, maybe it's time to take some of that money, instead of buying a truck. Let's invest in some new infrastructure in the business. Let's invest in some better technology, some new software. Something that's going to really drive the bottom line.
What other advice do you find yourself giving business owners? Like, I mean, I see a lot of times where the owner is and you said like they're the doer a lot, or they're
Yeah,
in it. It's hard. Either if they want to step fully out, they find themselves handcuffed to it for 2 to 5 years or 1 to 3 or whatever, or it just is lower because it's contingent on them. What else do you see?
I think the hardest, and I've had it happen a couple times, is yeah, just what you said. The business owner is like, I'm ready to retire. So my wife or husband is telling me I need to retire. I need to step away. I have nobody to. I mean, maybe I'll sell it to a key employee, but they may or may not be in a financial position that they can fund such a thing. Or in some cases they were planning on a child, or some sort of descendant taking over, and he or she has no interest in the business. They're off doing their own thing. It's like, well, what do I do? And sure, there's brokers out there, and places you can go and turn to help you sell that business. But one, it's certainly going to cost you a percentage of that value that you've worked to build. And yeah, it's going to be tougher, and it's going to be a harder row to hoe. Certainly the the more in advance of that moment where you can plan and say, okay, let me start thinking about how this is actually going to work. I've got one tax client I've been doing this for about 5 or 6 years with every year at tax time. It's like, okay, how far, when we met 5 years ago, you said we wanted to be done in 10 years. Where are we at on this progression now? Have you started sharing some of these, maybe they're not necessarily industry secrets or company secret, some of these things that that are in your head, that because you've been a doer all this time. Have you started transferring that knowledge to that next generation of ownership,
Hmm.
whether it's inside the family or outside the family?
Yeah. Yeah, I see that a lot. Are there other things that you see, like mistakes made, or even I know like a lot of times they're worried about their employees staying, or like a key
Yeah.
person will leave or stay. Maybe you don't when you don't want to stay. Like,
I mean, I can't think of anything beyond kind of what maybe some of the things we've already talked about. I think
yeah.
it's just really just, and probably all of them can be summed up in the cliche, failing to plan is planning to fail. So,
Mm,
just don't don't come to me 6 months before you're ready to retire and say we need to put a plan together. That's not going to work.
yeah.
Well, it'll work, but it's good. You're not gonna realize the full value of what you could have gotten.
Yeah.
Yeah, it's very much a matter of identifying who your potential buyers are, whether it's some people you have available now, or a hire you're going to make, or an external company, or we got to figure out who that potential buyer is, and then what are they going to be looking for? How can we start managing your finances in order to show the value to that buyer? Some of the hardest, you talked before, briefly mentioned, kind of talk about the emotional aspect, and I don't want to jump ahead too much.
No, we're going there soon. Yeah.
Yeah,
Go for it. Or we can go
some
now.
of the yeah some of the hardest emotional ones are the companies that where I kind of mentioned it's really just buying a job. In other words, the company itself really isn't worth much. A lot of times this tend to be kind of sole professional practitioners of some wide variety of industries. That they own a company, but it's them doing all the work. They're paying themselves a reasonable salary, but the business itself isn't really worth that much, because once he or she is gone, there's nothing there to
Yeah. There's no
leave to a
assets
buyer. There's
really.
no,
Yeah.
yeah, you might be have a little value in the name or the customer list that you've got. And again, in a professional practice, yeah, you're not talking about a lot of hard assets where there's a lot of buildings and equipment and land and things like that. So really, what is a buyer going to come in? And I've had, unfortunately, not a lot, thank goodness, a few evaluations that I've had to do where I've had to deliver that news, and
Hmm.
they think, well, I've made insert six-figure salary here. I made this much a year for the last 20 years doing this. It's got to be a lucrative business. And I said, well, no, there's two different hats you're wearing here. One is what you've made as a salary. That's your compensation for the work that you've done. That's not the value of your business. That's the value of the work that you've done. Have you taken dividends or distributions out of the business? Have you grown the business at all? Have you reinvested? Well, no, I haven't had well, yeah, because there's no value there. The business itself is not generating any
You are the
value, and
business.
you
Yeah.
are the business. And once
Yeah.
you step away, there's nothing to transfer to anyone.
Yeah. 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 You mentioned earlier having a client that you've been talking about the 10-year plan. So I'm a
Yeah,
huge proponent of planning early.
yeah.
And don't come to me 6 months ahead of time, right? How far in advance do you recommend? I mean, obviously it's a squishy number, I'm sure, but in
It
general.
is. Yeah, I mean, 10 years, that's probably extreme on one end. I don't have a lot of clients, nor do I think you probably need to at that early.
Hmm.
It really depends on how much work is going to be required. So, we talked about uh, having potential buyers lined up. If you've got I've got another client that we did 4 or 5 years ago that mom and dad have owned the company for a lot of years, very, very successful company. The daughter, in this case, had been very much part of the business for a long time. Very, very easy transition. About a year in advance, we got a valuation done, figured it out. She was ready to step in, and it was just an extremely smooth, and she's still very successful today. So in the case like that, yeah, maybe a year to 6 months to 2 years might be okay. If it's another opposite end of the spectrum, is I have no idea who's going to buy this, and we've been managing things for taxes all these years and been driving down my income for tax purposes. Okay, yeah, maybe we need to start looking. 5 years is probably a good time frame. That gives you enough time that some of your bad practices will roll off the back end, and won't hit the radar of the valuation.
Yeah. That's good. I know. So now just diving into some of the emotional side and my piece too, where,
Yeah.
I work with people trying to like overcoming the resistance of selling, right? Because I don't know what's
Yes,
next. I have worked with a lot of people who are like, I don't want to be a couch potato. I don't want to just, be done. Like, who am I if I don't run this business?
for
That's
sure.
the kind of stuff that I work with. So I want to know your experience with that. But I am always like, I started my practice when it was after and they were in bad shape.
Hmm.
And so I'm working really hard to be like, let's talk about this sooner. And even before like the valuation and all the deal making starts, because then you're so focused on the deal making. But like even a year or two ahead of when you're thinking like, what's next? What's your next
Yeah,
thing? Like, what's your new identity? What's your new activity? And to not have anxiety about that, but to actually have some excitement about,
yeah.
okay, I'm both still in my business and I'm going to go like right off into the sunset of my own design.
Right. Yeah. And that's a really hard conversation. Again, of the types of businesses I'm working with, a lot of these are businesses that have been, these are entrepreneurs that have built the business from the ground up. They have poured, 30, 40 years of their life. In some cases, you might even, their identity is, I mean, the business and themselves, they really don't necessarily have a separate identity to say, when I pull away from this, who am I? In some cases, we've long said in the industry that accountants and valuators probably need to take a little bit more psychology in college and have that more part of our core curriculum, because there is in many cases a level of psychology, because it is such an emotional, financial impacts to people. It can be a really really emotional conversation to have, whether it's the value of your business, or whether it's you owe a lot more tax than you were expecting, or no, you can't deduct your pet, or whatever. There's a lot of psychology that goes
Can't
on
deduct
in
your pet.
there's a lot of psychology that goes on in our industry.
Yes.
So yeah, I mean that can be a really really hard conversation.
I'm curious. Oh, sorry.
No, you're fine.
I
I was just gonna say, a lot of times, the valuation sometimes is really the first step in a long process of planning and transition planning. We'll maybe in some cases look for ways, or maybe, okay, maybe let's keep you in the business. Maybe you're a consultant for 3 to 5 years,
mhm.
instead of, if your business is worth X, maybe we'll back that down by 10% and pay you a consultant fee for the next 3 to 5 years, and you can come into the office and read the paper, and go bother everyone in their cubicles, and still feel like you're connected. But at the end of the day, we're running the business now, but you can at least still feel that connection, because
Yes.
you've been coming to the office every day for the last 35 years. And yeah, it's going to be hard to just cut the ties and say, sorry, you're not an owner anymore. You need to leave.
Yeah, we don't want you. We don't want your opinion
Yeah, and we
anymore. We
don't
don't
and we
want your
don't value you.
expertise. Yeah,
And it's a great way to make that person still feel valued, and a part of what they've built.
totally. Well, and I when I'm talking to them too, it's like if you don't know what you're retiring to or moving on to, then how do you know how much money you need?
Yeah,
Right?
for
So it's like you think you need 10 million, maybe you only need 5, or you think you need 5 and maybe you need 10 for what you've just designed for yourself. So I think that feeds in nicely to the valuation where it's like, okay, I think I want this lifestyle and my number is there, not there, whatever. And then it also feels like there's 2 parts or maybe 3 parts of the psychology. There's like, what am I going to do after? And then like, I'm sorry, you told me it's worth how much? Like,
yeah,
like I beg your pardon,
yep,
and
yep.
adjusting and digesting that. And then the reality of actually letting the business go. There's like psychology there
Oh,
too.
for
So
sure, for sure.
yeah,
And yeah, and I have a lot of business owners that, again, they've gone to their industry conferences and they get drilled into their head. Oh, in our industry, your business is worth X times your revenue, or X times
hmm
your EBITDA, or whatever. And so
yeah,
they just come in, they're sure, they like, I don't know why I need this, because I know what it's worth. And then you give them something different. In some cases, they're pleasantly surprised. In some cases, they're not pleasantly surprised.
right.
So that's a conversation too, a lot that we have is, yeah, well, you have to remember how these kind of rules of thumb and averages are developed. They're looking at a large population and saying, well, this is the average.
Yeah.
Your business may be on this end of the population, your business may be on this. There may not really be any businesses at all there, but there's just enough businesses over here and enough businesses over here that becomes the average, but it doesn't really mean anything. So you have to be really, really careful. That is another conversation I tend to have a lot, is you have to be really. I get it a lot on the front end when I'm having that kind of initial with business owners. They say, "Well, I'm pretty sure it's worth X because this is what my industry tells me it's worth." And I say, "Well, you got to be really." I try to get you got to be really careful about that, because your business may be a star in the industry. In that case, you wouldn't want to settle for that because you're on the top end, or perhaps you're on the bottom end. Maybe you've got a ton of obsolete inventory, or who knows what
Yeah.
number of reasons why you're not
Missing
performing as
SOPs.
well.
Yeah.
Yeah,
Yeah. Yeah.
your accounting system is a mess. There's you have no idea where you're at. So just be very. I always try to emphasize, be very careful on using those industry rules of thumb. They can be helpful, but don't rely on them, and we certainly don't in the valuation.
Yeah. And in your experience, are they pretty, like, once they get over the initial shock of it all, fairly okay with it? Or do you have to talk them off the ledge a few times?
Yeah, not only one I've had that really, really fought me on. Once I've kind of explained, okay, this is how I did it, and this is why I did it, and some of the adjustments I made, and why I don't think this is a great average for you. Most of them will come around and see the light, or at least to my face tell me that. They're probably in the
Yeah.
back of their head still saying, this guy doesn't know what he's talking about. But there's just been one that I had really had to have that conversation multiple times with, and I'm not, again, I'm not a psychologist. I'm not sure he ever really fully accepted it, but at the end of the day,
Yeah.
we finished the engagement on pleasant terms, so all was well.
Yeah. And when the business sold for what it sold for,
Yeah,
that was
yeah,
the answer, right?
yeah. And
Yeah.
unfortunately, that was one it wasn't a client of mine, so I didn't get a lot of follow up. So I'm not sure
Mm,
exactly what happened or how that all went. If I was closer, or if he was closer, but
yeah. Yeah.
or
Yeah.
if he even sold it at all, and I'm not even sure. So
No, well, that's a whole nother topic, right? Yeah.
yeah,
That's
exactly,
a whole nother topic.
exactly.
Chris, thank you for all of this. I love the fact that you are both a CPA and a valuation expert as well and have that expertise and that your clients can tap into that. But how do people find you? Just like talk a little bit about how you manage the two factors, like either for your clients or within your firm. Just give
Yeah.
us a little overview.
Again, like I would say, it's kind of like the same with the business owner. They're wearing two hats. If they're working in the business, I'm the same way.
Yeah.
If I'm your tax accountant, I'm putting on my tax hat and giving you advice for taxes. If I'm if
Hmm.
I'm your valuation expert, then I'm putting my other hat on too. You can find me on LinkedIn. I've got a personal account. Our firm, LattaHarris, also has an account. You can find us either way. Probably the best way is through our website, which is just LattaHarris. Link at the top where you can click on it and it says "Let's collaborate," and it's a great way to introduce yourself and what you're looking for and how we can help you out. And if valuation is what you're looking for, they'll put you in touch with me, and we can go from there.
Awesome. And so we talked about million or a couple million, but talk about the range of the value. You said
Yeah,
you don't do public, usually it's usually private. Just give a little
yeah,
parameter there.
yeah. I mean, I think the smallest valuation number I ever gave was $25,000.
Okay.
Probably, I feel a little bad, and probably I would almost say they might have wasted their money. It was probably not worth them paying me to do it, but
Yeah.
in this case, it was one of those required things. So it wasn't just a
A
internal
punch in the
use type
face.
thing.
Yeah.
Yeah. So that was the small. I think the biggest one I've ever done is probably 20 some million. So yeah,
Okay.
you're probably revenues of up to maybe 50 million.
Okay.
I don't know that I'm necessarily limited to that, other than I just don't want to get into a lot of the publicly traded SEC type stuff, just because there's a lot of compliance stuff there that I don't have that specific training for. So
Yeah.
small,
Perfect.
small business of just about any industry. I don't think I've ever turned one down because of the industry they were in.
Okay.
But yeah,
Great. Well,
yeah,
thank you so much for your time. Thanks for sharing your knowledge with business owners. Hopefully they have some good takeaways from this and avoid some pitfalls and some missteps going forward.
yep. Thank you, Cindy, and thank you, Interwovenly. I hope this was valuable, and appreciate your time.
Thank you.
Yeah.